If you've spent any time reading about investing, you've almost certainly encountered these four terms: mutual fund, index fund, ETF, hedge fund. They often appear in the same conversation, sometimes used interchangeably, which creates a reasonable amount of confusion, because they're not the same thing. They share a common foundation, but they're built differently, they behave differently, and they're suited to very different types of investors. Today, we're going to work through all four. Clearly, without jargon, so that by the end, you can look at any of these terms and understand exactly what you're dealing with. What a fund actually is. Before we get into the differences, it helps to understand what all four of these things have in common. A fund, at its most basic, is a pool. Many individual investors contribute money into a shared structure, and that combined capital is used to purchase a collection of assets, stocks, bonds, real estate, or some combination. Each investor owns a proportional share of the whole pool, not any single asset within it. The appeal of this structure is straightforward. If you had $1,000 to invest on your own, you could buy shares in perhaps one or two companies. One bad quarter from either of them could significantly damage your position. But if that same $1,000 goes into a fund holding hundreds of different assets, the performance of any single one matters far less. This principle, spreading risk across many assets, is called diversification, and it's the core reason funds exist. The differences between fund types come down to three questions: who decides what goes in the fund, how is it traded, and who is allowed to use it. Index funds. An index fund is, in many ways, the simplest idea in modern investing, and arguably one of the most effective. Rather than having a manager decide which assets to hold, an index fund simply mirrors an existing market index. The S&P 500, for example, tracks the 500 largest publicly traded companies in the United States. An S&P 500 index fund holds those same 500 companies, in the same proportions. When the index changes, because a company grows large enough to enter, or shrinks enough to exit, the fund adjusts to match. No one is making active decisions, no analyst is deciding which companies look promising. The fund follows a rule, and the rule follows the index. Because there's no active management involved, the costs are low. Index funds typically charge what's called an expense ratio, an annual fee expressed as a percentage of your investment. For many index funds, that fee is between 0.03% and 0.2% per year. On a $10,000 investment, that's $3 to $20 annually. The long-term case for index funds is well documented. The majority of actively managed funds, where professionals try to outperform the market through selection and timing, underperform their benchmark index over a 10 or 20-year period, particularly after fees are accounted for. Matching the market, consistently, over decades, tends to produce better outcomes than trying to beat it. Index funds trade once per day, after the market closes, at a price that reflects the total value of the fund's holdings at that moment. They're well suited to investors who want broad market exposure, low costs, and minimal ongoing involvement. ETFs, exchange-traded funds. An ETF, or exchange-traded fund, shares its DNA with the index fund. Most ETFs track an index, hold a diversified basket of assets, and carry similarly low fees. The key structural difference is in how they trade. Unlike index funds, which price and trade once daily, ETFs are listed on stock exchanges and trade throughout the day. Exactly like individual shares, you can buy at 10 in the morning and sell at 2 in the afternoon if you choose. The price fluctuates in real time based on supply and demand. This creates a meaningfully different experience for the investor. ETFs also tend to be somewhat more tax efficient than traditional mutual funds due to how they handle the creation and redemption of shares, a technical process that generally avoids triggering the taxable events that mutual fund transactions sometimes generate. Like index funds, ETFs can be started with a relatively small amount, in many cases, the price of a single share, which might be anywhere from a few dollars to a few hundred depending on the fund. There are also actively managed ETFs, funds that use the ETF structure but have a manager making investment decisions rather than simply tracking an index. These are less common and typically carry higher fees than passive ETFs, but they exist. For someone who wants the diversification and low cost of an index fund but prefers the flexibility of being able to buy and sell at any point during market hours, an ETF is often the natural choice. Mutual funds. Mutual funds are the oldest of the four structures we're discussing, and in many ways they defined what most people think of when they hear the word fund. Like index funds and ETFs, mutual funds pool money from many investors and deploy it across a range of assets, but the defining characteristic of most mutual funds is active management. A professional portfolio manager, supported by a team of analysts, makes ongoing decisions about what to buy, what to sell, and when. The goal is typically to outperform the broader market, not merely to match it. That expertise comes at a cost. Mutual fund expense ratios are generally higher than those of index funds or ETFs, commonly ranging from 0.5% to 1.5% per year, and sometimes more. The difference might sound small in percentage terms, but compounded over decades, even a 1% difference in annual fees has a substantial effect on final returns. Mutual funds, like index funds, trade once per day after market close. You can't buy or sell at a specific price during the trading day. Your transaction executes at whatever the fund's net asset value turns out to be at the end of that day. This structure discourages short-term trading, which suits investors with a longer time horizon. The question that always accompanies mutual funds is whether active management justifies its additional cost. The data suggest that, on average and over long periods, most actively managed funds do not consistently outperform their benchmark index after fees. There are exceptions. Some managers have demonstrated genuine skill over sustained periods, but identifying them in advance is difficult. Mutual funds are regulated, transparent in their holdings, reported regularly, and widely available through retirement accounts and brokerage platforms. For investors who want professional management and are willing to pay for it, they remain a legitimate option. Hedge funds. Hedge funds occupy a different category altogether, not just in structure, but in who they're designed for and how they operate. Access is the first distinction. Hedge funds are generally restricted to accredited investors, individuals or institutions that meet specific income or net worth thresholds. The minimum investment is typically very high, often in the hundreds of thousands of dollars, and sometimes much more. The reason for these restrictions is the nature of the strategies involved. Hedge funds are not limited to buying assets and holding them. They can short sell, profiting when an asset falls in value. They can use leverage, borrowing capital to amplify positions. They can trade derivatives, financial instruments whose value is derived from underlying assets. They can take concentrated bets, move quickly, and operate across multiple markets and asset classes simultaneously. These strategies can generate returns in environments where conventional funds struggle, but they also carry risks that are not appropriate for most investors. The fee structure reflects the premium placed on the manager's skill. The most common model charges 2% of assets under management annually, plus 20% of any profits generated. This means the manager benefits substantially when the fund performs well, and continues to collect management fees even when it doesn't. Hedge funds are less regulated than mutual funds or ETFs, which gives managers more flexibility but also less external oversight. Results vary considerably. Some hedge funds have delivered exceptional long-term returns, many have not. They are designed for a specific type of investor, one with significant capital, a high tolerance for risk, and the financial sophistication to understand the strategies being employed. How they compare. Let's place them side by side. Index funds are passively managed, low cost, and designed to match the market. They trade once daily. They're available to almost anyone and require minimal ongoing attention, suited to investors who want broad market exposure over the long term without complexity. ETFs share most characteristics with index funds: low cost, typically passive, diversified, but trade throughout the day like stocks. They offer slightly more flexibility and are generally tax efficient, suited to investors who want the core benefits of index investing with more control over timing. Mutual funds are actively managed by professional teams aiming to outperform the market. They carry higher fees, trade once daily, and are widely available through retirement accounts, suited to investors willing to pay for active management and comfortable with the evidence that most active managers underperform over time. Hedge funds use complex, sometimes aggressive strategies available only to qualified investors with substantial capital. Fees are high, regulation is limited, and outcomes are highly variable, suited to experienced, high-net-worth investors seeking strategies beyond conventional market exposure. Which one is right for you? The honest answer is that this depends on where you are financially and what you're trying to accomplish. For most people, particularly those building wealth over a long time horizon, index funds and ETFs offer a combination of simplicity, low cost, and reliable long-term performance that is difficult to improve on. The evidence for this is consistent across decades and markets. Mutual funds can be appropriate in specific contexts. Certain retirement plans, for instance, may offer actively managed options with reasonable track records. The key is understanding the fees and comparing them honestly to what a passive alternative would cost. Hedge funds are not relevant for most investors, and that's not a limitation, it's simply a reality of who these structures are designed for. The most important principle across all four is this: the best investment is the one you understand, that fits your time horizon, and that you can stay committed to through periods of market volatility. Complexity isn't the same as sophistication, and higher cost isn't the same as higher quality. If this gave you a clearer picture of how these four types of funds differ, and which might make sense for your situation, then this channel is worth following. We cover personal finance concepts clearly and thoroughly, so you can make informed decisions with confidence. Subscribe if you'd like more of that, and I'll see you in the next one.